Market narrowly averts a bear market on Friday. Can it hold today? That's coming up on 3 Minutes on Markets and Money. This morning, futures are pointing higher out of the gate. On Friday, the markets did break that 20% barrier, having the media immediately jump to, it's a bear market in the S&P. No, not really. First of all, 20% down in the S&P today no longer really represents a bear market. It is simply a correction because the long-term bullish trend, rising prices, remains well intact here. We're going to have a much deeper decline to actually break that long-term bullish trend of the markets going back to 2009. However, markets did break that 20% barrier on Friday. Now, the good news was we had buying come in late afternoon, and we actually held this support going back to last week. Incredibly important here because, again, as markets look to try to bottom here in order to string together a bit of a rally, we need to make sure those lows hold. Today, markets are looking to point a little bit higher here. That would be a good indication that maybe that market bottom can hold. We'll have a nice double bottom, retest at 3 standard deviations below the moving average. Now we potentially get this rally. First key test is going to be right here at 4,000 on the S&P. The S&P needs to get above 4,000. That's where the 20-day moving average is sitting at this moment. A break above 4,000 on the S&P can get us up potentially to 4,200 right before you run into the 50-day moving average. Now, there are several downtrends that we've got to deal with here. And again, right where the 20-day moving average is, that's really been the previous peak of every rally attempt going back to basically March, where we peaked out in that rally coming off the March lows as well. So again, as we have this downtrend very defined in the market, it's been very defined on this way down. A breakout of that could certainly give the market a bit of lift here. Now, the good news is that volatility has not really been indicating that we're in a severe panic-driven selling bear market. We have a lot of selling pressure here, but volatility really not supporting that view. If we take a look at the VIX, of course, what we did see here is that markets did actually have a volatility increase really ever since that peak of the market back in March. But here over the last couple of weeks, as we've had this really consistent selling in the market, volatility has actually been declining here, really not showing that there's a tremendous amount of panic in the market. So despite the fact we've had this kind of consistent selling pressure in the markets, seems like every day for the last 8 weeks, volatility, has not been spiking really hard here. We're not pushing into much higher levels of 40, 50, 60 on the volatility index is what you would expect in a bear-driven market sell-off. Actually, though, markets have been declining. It's been fairly orderly here. It's not been fun, but it's been orderly. Volatility is declining here. And again, if we can get volatility to come down here into the low 20s and even potentially break 20, we could see this market kind of continue this rally that we're talking about, this reflexive rally. 8 straight weeks of selling in the Dow, 7 straight weeks of selling in the S&P, a couple of positive weeks in the markets would not be surprising here at all. That would be a great time to rebalance risk, reposition portfolios for what happens as we get later into the summer, later this year, as the Fed begins to hike rates and tighten monetary policy even more. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. Be back here tomorrow.